Alright, welcome back. On to part one. This is a fictional illustration for educational purposes only. Assumptions are simplified and may not reflect your situation. Rules can change, and agency plan details vary. This is not legal, tax, or financial advice. Before taking actions, verify details with your agency, HR, OPM, plan materials, FEHB, FEGLI, TSP, and a qualified professional. Okay, so here's the story time for one of the bigger impacts that you can have. Two brothers, one system, two very different retirements. They grew up sharing a bedroom and a beat-up truck. After 4 years of active duty service together, the brothers split towards the same goal: civilian federal careers. Same agency, same grade to start, similar promotions, similar salaries. From the outside, Daniel and Michael looked like twins, on paper and at the office. But a few one-hour decisions, made or ignored at the right moments, bent their lives in opposite directions. Year 1. The setup. Daniel sat down with HR the first month. He confirmed he was under FERS and pulled an official service history record. He noticed his temporary appointment counted for nothing, but his 4 years of military time could be bought back for credit. He filed the deposit paperwork while interest was still small. He also opened the beneficiary forms that felt for later, quote unquote, and updated FERS, FEGLI, and TSP beneficiaries to his wife, Anna. Michael meant to do the same after the move. He assumed they know my service and tossed the unopened FEGLI envelope into a desk drawer and told himself he'd deal with the military deposit when the kids sleep better. He never sent the beneficiary updates. Fork in the road number 1. Daniel buys back 4 military years. For a lifetime pension bump, this could be up to $120,000 for a relatively small deposit. Again, lifetime could be 10, 20, 30 years, right? Michael delays, never does it. Ages 35 to 49, the middle years. Daniel automated his TSP at a 5% minimum from day 1, then stair-stepped contributions with raises. He turned on catch-up at 50 in his calendar years before he needed it. He also avoided capping out early, keeping contributions every pay period so the agency match never shut off. Michael meant to bump it later. Twice he front-loaded TSP to max by October, accidentally turning off his match for the last pay periods of the year. He shrugged, small stuff. Fork in the road number 2. Daniel's paper period contributions resulted in a full match. Michael front-loading loses potentially $24,000 match over 20 years. That's not even counting growth. At 55, the first big decision. The brothers hit their minimum retirement age, in different birth years, but both around 57. Daniel's career count. 26 years of civilian service, plus 4 years of bought back military time, results in 30 years by age 57. MRA plus 30. He retired in the calendar year he turned 55 plus 57, and left funds in TSP, preserving the age 55 separation exception on TSP withdrawals. Generally avoids the 10% early withdrawal penalty for TSP taken after separation in or after the year you turn 55. He planned light consulting that kept earnings below the FERS annuity supplement test, so the supplement bridged him to 62. Michael's career count. 28 years of civilian service, no military deposit, so 28 total by 57. He didn't meet the MRA plus 30 and didn't want to wait. He eyed MRA plus 10, not realizing the 5% per year permanent reduction for each year under 62. He also rolled TSP into an IRA, individual retirement account, forfeiting the age 55 exception. Early withdrawals were subject to the 10% penalty. He took a full-time post-retirement job. The pay felt great, until his first supplement was reduced by the earnings test, often to zero, at full-time income levels. Fork in the road number 3. Daniel retires MRA plus 30 at 57, resulting in about $30,000 a year. Michael retires at MRA plus 10 at 57 and $21,000 a year. It's a $9,000 gap every year. Now, over 30 years, that could be $270,000. Now, MRA is based on birth year. MRA is usually between 56 and 57. MRA plus 10 retirements generally face a 5% per year reduction for each year under the age of 62, unless you postpone. The age 55 exception applies to TSP after separation in or after the year you turn 55. It generally does not apply to IRA withdrawals. Good. So that's the main story here. So we'll keep going. We've got a couple more things here. The FEHB trapdoor. 2 years before retiring, Daniel double-checked the FEHB 5-year rule, covered under FEHB for the 5 years immediately before retirement or since first eligibility, and kept continuous coverage. He chose a full survivor election, 50%, at retirement, so Anna, his wife, would keep FEHB if he died first. That same year, Michael jumped to his wife's private plan for a cheaper family premium and canceled FEHB, not realizing this reset his FEHB 5-year clock. At retirement, he discovered he didn't qualify to continue FEHB. To save pension dollars, he waived the survivor annuity, thinking, well, we'll buy life insurance if we need it, quote unquote. This is another fork in the road. Number 4. Daniel, confirming his 5-year FEHB, his spouse is protected. Michael canceling it mid-career loses that continuation. That could cost you up to $20,000 a year, or just a loss of benefit, which over 20 years, I don't know about you, but I would think at 60 or 57, I'd have another 20 years to live. That could be $240,000 in lost benefits. All right, let's keep going. Now we're going to look at FEGLI at the finish line. At retirement, Daniel selected FEGLI Basic with the 75% reduction, a low premium option designed to phase down coverage in retirement. Michael kept FEGLI Basic with no reduction. I want the full amount for life. He didn't price the long-run premiums. 20 years later, he had paid well over 5 figures, more than needed, and still didn't have the coordinated survivor protection that FEGLI was never designed to replace. Age 62 in Medicare. Daniel hit 62 and let the first supplement end as planned. When Medicare arrived, he and Anna compared doctors and travel habits. They elected Part B to reduce out-of-pocket surprises and paired it with FEHB. Michael, now facing private insurance after losing FEHB, balked at Part B, another bill. A single out-of-network hospitalization with 20% coinsurance erased years of premium savings. Later enrollment added permanent late penalties. 10 years later, 2 kitchen tables. Daniel and Anna, pension uses all credited service, including bought-back military time and converted sick leave. FEHB for life, sensible FEGLI that declined as intended, a right-sized survivor annuity, and a TSP that kept every match and avoided unnecessary penalties. Cash flow is predictable. Medical surprises are nuisances, not derailers. Michael and Leah. Private insurance increases feel like a second mortgage. The pension is permanently reduced from the MRA plus 10 timing. The supplement never helped because of earnings, and TSP to IRA withdrawals were nicked by the 10% penalty in the early years. Without a survivor election, Leah can't keep FEHB even if otherwise eligible. Life insurance premiums didn't solve the coverage problem FEHB would have handled. Both brothers were equally hardworking. Only one spent 10 focused hours making 10 quiet decisions. Takeaways. 10 hours that change everything. You don't need luck or a perfect career to retire well under furs. You need 10 one-hour sessions. Calendar blocks you can schedule this month to lock in decisions worth 5 to 6 figures. The Brothers' Stories isn't about earning more, it's about owning the rules. Oh, this light is not doing what I want it to do. Fix that for a second. You get the raw and real deal here. Okay, good. So the Brothers' Story isn't about earning more, it's about owning the rules. Use the checklist, take the hour, make the call. Your future self and your spouse are already sitting at that kitchen table. Which stack of papers do you want in front of them? Assumptions for the numbered callouts. This is illustrative only. The high 3 at 100,000. Daniel, MRA plus 30 at 57 with 4 years military buyback, 30 years total. Michael retires at 57 on MRA plus 10, no buyback, 28 years, rolls TSP into IRA. FEHB replacement if lost, about $12,000 a year, over 20 years. First supplement, about $12,000 a year to age 62. Earnings test can reduce 0 it. TSP match lost by front loading, about $1,200 a year. Over 20 years is $24,000, ignoring growth. Early withdrawal penalties could be $10,000 in this example. And FEGLI, no reduction, extra premiums could be $20,000 over 20 years, about $1,000 a year, or about $100 a month. Good. Some more comparisons here. So we're looking at pension at 57. The percentage change, Daniel versus Michael, with those reductions was 30,000 versus 21,000. That gap of 9,000 a year is over 270,000 over 30 years, which doesn't even include the cost of living adjustments. Military buyback, we talked about that, 4,000 a year over 30 years. That's 120,000. And then the FEHB. So always confirm your actual eligibility, service credit, and costs with official sources before making decisions. Good. So now, next video, we're going to go into the quick wins, which I want to take each one of these points and really just go into each one of them. I'll see you in the next one.